What changes are on the way and are they achievable? Kate Moody's been finding out. Kate.
Well, Emmanuel Macron's plans were temporarily thrown off track by the public auditor, which revealed the French government was facing an €8 billion hole in its finances that could have forced flagship tax reforms to be delayed. But they were put back on their original timeline as the budget minister said around €4.5 billion in public spending would be cut from a number of ministries without affecting public services or taxes. Among the president's headline campaign promises was a plan to scrap a local housing tax on 80% of French households, which brings in about €10 billion a year. He wants to scale back a wealth tax so it applies to property rather than financial assets, and he's vowed to reduce the corporate tax rate from 33% to 25% during his 5-year term. The last two measures in particular have appealed to businesses, coupled with other reforms specifically designed to court financial firms. From next year, the government plans to impose a flat 30% tax on dividends and other earnings linked to investments. It's also building on François Hollande's system of tax credits for companies that hire, which will be transformed into a permanent lower rate of payroll charges. Now, overall, Prime Minister Édouard Philippe says the tax burden on businesses and individuals will be reduced by €11 billion in 2018. Taxes will be raised on items like cigarettes and diesel fuel. Combined with hefty spending cuts and deep structural reforms, the government believes it will be enough to compensate for the holes left by lower tax revenue, all while bringing down the deficit to the EU's 3% target.